I want to have a discussion with you now about company valuation, EBITDA versus discount rate. I was recently asked by a friend for a quick guide to valuing a company. The question he specifically put was, in a nutshell, what is the formula you would use to value a company? So, Mark, this is a more considered response to your excellent question that I gave you a very short response to when you posted it online. The issue can be distilled, I think, down to EBITDA versus discount rate. Essentially, profit multiples versus cash flow based internal rates of return. Already, the parameters are spreading. The first problem with EBITDA, in my view, but one I am pleased to say that is shared by Warren Buffett, is that EBITDA valuations and multiples take no account of capital expenditure, CapEx, which then means you're excluding depreciation, and it takes no account of the book value of intangibles, which therefore excludes amortization. So essentially, we're looking at a business valuation which is irrespective of the tangible and intangible asset investment. So you're valuing a company that has a very heavy CapEx spend and lots of fixed assets and maybe lots of intangibles against one that has none at all. And you're valuing them on the same basis, which to me intuitively doesn't make sense. The next question, which is also difficult to answer, other than on a rule of thumb basis, is which multiple do you use? Now, venture capital and PE houses who love to negotiate with EBITDA multiples, although they also run complex DCF models using discount rates, are always looking for entry multiple arbitrage. That is to say, can they buy at a low multiple and then sell later at a higher multiple? Because this is one of the easiest ways for them to generate positive financial returns in their deal. And I have been in the room when PE houses and VE houses have literally dropped values by changing the PE multiple, by the EBITDA multiple, and arguing for the new valuation. And it's a pure game of multiple arbitrage. Now, we're going to take a look at Apple, and you can see from the metrics which come from Yahoo Finance that Apple, as of today, is trading at an enterprise to EBITDA multiple of 22.77. So it's on a 22 times EBITDA multiple, which is pretty rich, although, of course, we are talking about Apple. Note that we're looking here at the enterprise value, not the market cap. Now, the statistics provided by Yahoo Finance also provide other useful ratios which you can work with in exactly the same way. So we have the trailing and forward PE. We have the PEG ratio, which is the price earnings to growth ratio. We also have the price to sales, the price to book, and the enterprise to revenue. So we don't just have to look at EBITDA if we want to go down the ratio route. There's a whole stack of different ratios which we can explore and play with to see what sort of numbers we come up with. And of course, these ratios are useful for trend analysis and for comparison with other companies. How does this compare to Microsoft or Google, for instance? But how do we decide on the right multiples if we're seeking to value a company and we don't have a market listing? Put another way, how do we know whether this multiple represents fair value or whether Apple is under or overvalued? It doesn't really tell us that. If we now turn to discount rates, how can we use these to easily value a business and identify its intrinsic worth? Without creating a complex discounted cash flow model, DCF model, with all its assumptions, its integrated three financial statements and its outputs, let's try to shortcut and answer the question in a, quotes, nutshell. The first question to answer, of course, is what is the right discount rate? Now, I readily admit that this is not a straightforward question, but at least we can derive our discount rate on the basis of some financial theory, the capital asset pricing model, or CAPM, for all its faults. The discount rate comprises the risk-free rate, the equity risk premium, and the company's specific beta. Now, Apple's beta, which is shown to us by Yahoo Finance, is 1.21. Now, it's also important to consider whether you need to have levered or unlevered betas, and this depends on which cash flow you're using. These numbers come from in-front analytics. You can see from the information, though, that the Yahoo Finance and the in-front analytics numbers don't agree. Now, the Yahoo Finance have calculated their beta on a 5-year basis monthly, and in-front analytics give us a 1, 2, and a 3-year beta. So, it's getting all rather confusing. It's not clear as well from the screen and the information we're getting whether they're talking about asset or equity betas, although I'm sort of assuming these are equity betas. It's important as well that you use the right discount rate with the right cash flow, and you also have to ensure that you adjust the discount rate for tax if necessary. So if we look at the capital cash flow, which is defined as operating cash flow less actual taxes paid, this requires a discount rate using the asset beta, since the capital cash flow is cash flow to the whole firm. So we have the expected return equals the risk-free rate divided by brackets, the asset beta times the risk premium. Now this returns, if we have the enterprise value, we can derive the implied discount rate for using this calculation and that particular cash flow, and the implied discount rate is 3.01%. So we're reverse engineering this. We'll get to a proper calculation in a minute. The equity cash flow uses the equity beta, as now we're only measuring the cash flow to equity, and this beta should be unlevered because there's no gearing, because there's no debt. And we use this to derive the market capitalization of the firm. It's basically the share price and the equity. So the expected return is the risk-free rate divided by the equity beta times the risk premium, but it's the equity beta, and it's applied to the equity cash flows. And the unlevered beta is the levered equity beta divided by 1 plus D, which is the debt to equity ratio. But don't get too confused about this, but I'm just trying to show you that you need to be very careful which cash flows you use, which discount rates you use, whether you're leveraging them or unleveraging them, and whether you'll be taking into account the benefits of tax shelters. Equity cash flow measures the cash available to stockholders after payment to debt holders. So it's the capital cash flow minus interest and debt payments plus debt issues. And this is discounted at the equity rate of return. The free cash flow measures the value of the whole firm. So we include the cost of the debt, and we need a discount that balances the debt and the equity ratio. And for this, we use the weighted average cost of capital. The free cash flow is actually stated on the summary of the cash flow statement, so we can use it directly. And the implied WACC produces a rate of 3.23 based on the enterprise value of the firm. But let's go back to the basics and work the problem out from the bottom. The current US 10-year Treasury bond is trading at 1.5%. The current US equity risk premium is at 5.2%. Using Google, we can easily find Apple's cost of debt, which is 2.606%. We can use the same technique to identify the current cost of equity, which is 7.4%. And we can also find out Apple's effective tax rate, which is 24.6%. From this, we can calculate Apple's after-tax cost of debt, 1.96, and we do the calculation and we confirm that the cost of equity is 4.3%. So from the 2020 financial statements, we can see that Apple has net debt of $74.2 billion and shareholder equity is $65.34 billion. And this gives us the debt, the relative weighting of debt and equity, which we need for the weighted average cost of capital calculation. So from this, we can calculate that the cost of equity, weighted cost of equity is 3.47%. The weighted cost of debt is 1.05%. So the weighted average cost of capital for Apple from ground zero, from building it up, is 4.52%. If we use this weighted average cost of capital as a discount rate for the free cash flow, then the enterprise value from our calculation is 1.62 trillion. The current market capitalization is 2.34 trillion. In fact, the enterprise value is 2.27 trillion, so there's almost no difference there. So Apple is therefore trading at a 44% premium to its historic implied enterprise value based on our discounted cash flow. Now, there may be some critical timing differences here, so again you have to start looking into the detail of all the numbers, and these are important, particularly for fast-growing and highly rated companies. If we look at Apple's stock price on the 26th of September 2020, which is the day the results came out, the price of $108 only represents a 16.8% premium to our calculated enterprise value. And bear in mind, this is with the background of very strong share price growth in the preceding 2 years, which may have led to there being a lead on the valuation ahead of the results. The other difficulty, of course, is apples and pears, no pun intended, profits versus cash flow. An increase of 37% increase in earnings per share cannot be extrapolated to a 37% increase in free cash flow. Now, if we're looking at the trailing 12 months, the TTM, the free cash flow, the implied enterprise value is just over 2 trillion. So the current market capitalization is only 17% higher. And of course, we're well into Q3, so this may not be that far out of line. So let's then go back to profit ratios, and particularly the price earnings ratio. In 2020, Apple's fully diluted earnings per share was 3.28, but the consensus forecast for Apple's earnings in 2021 is 4.45, which is an increase of 35.7%. So the trailing and forward PEs are showing as being 30.11, which and 25.04, and I believe the forward PE is actually looking forward to 2022, not 2021. Unfortunately, this does not tell us anything about value, but only price, and the two are very different. Value and price is not the same thing. So what is the right PE ratio with which to value Apple? And the answer is, I don't know. And perhaps that is the problem. The use of EBITDA multiples or PE multiples depend on price and tell us nothing about intrinsic value. If you think the price is too high or too low, you are entitled to your relative opinion. But the question I would ask is, what is the basis for that opinion? If we use discount rates, we're valuing the risk associated with the cash flow, a measure of intrinsic value. Now, we may be prepared to pay more, or we may not, and that depends on our opinion. But the valuation is based on a risk calculation and cash, not profits. Of course, we can use a comparative PE or EBITDA multiple to calculate a value, although peer group selection is always a problem. Or we can calculate discount rates to arrive at an intrinsic value. What this tells us at the end of the day then depends on our perception of price and value, because it doesn't tell me whether that's the right price for the share. The value I come up with isn't necessarily the right price for the company. Let me then end by returning to Mark's question. In a nutshell, what is the formula you would use to value a company? Well, my preference, and I hope you can see it now, would be for discount rates over profit multiples, as I think the latter gives a better indication of intrinsic value, whereas profit multiples are much more subjective. But we have seen that this is a long answer to a short question, and the more you look into it, the more complex the problem becomes, and indeed more questions arise. And maybe that highlights a different problem. How can you get a short answer to a short question from an investment banker? So I hope you've enjoyed this discussion of company valuation, where we're looking at the difference between using multiples, profit multiples, in this case EBITDA, versus discount rates and cash flow to come up with company valuations, and how problematic it is on both sides of the equation. But if I was to try to make a judgment and say which one I preferred, I would go for the discount rate over the multiple every time.